Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I am your co-host, Jared Lee.
And I'm Ben Rose. Good to see you.
And you, sir?
And today we are not alone.
We aren't.
We have special guests with us from Kita, Natalia Dorfman, the CEO, and James Kench, the head of insurance. Welcome to the show.
Welcome.
Thank you very much. It's good to be here.
So we've got a jam-packed agenda, completely unstructured, as we've explained. And slightly alarmed look, seeing we didn't have any notes in front of us at all. But we're going to do a whistle-stop tour of the carbon markets, the cross-section between those markets and the insurance markets, and how Kita came to come between them and give a promising new opportunity for the reinsurance market, as far as we're concerned. Mm-hmm. So how about we start off with some introductions? Natalia, do you want to go first and tell us a bit about yourself?
Yeah, sure. I'm Natalia Dorfman, CEO and co-founder of Kita. I am a Southern California beach child, which does actually inform some of my decisions to start Kita. I like being outside. I majored in environmental science at university because I thought I could go hiking, as every parent wants their child to do. But then I ended up doing business development and strategy for large global law firms for 15 years, so in New York, Brussels, and London. And I spent 8.5 of those years at Clyde & Co. So probably most people listening know Clyde & Co. from the insurance side. And that is where I learned about the sophisticated world of insurance, specialty insurance, et cetera. And over time there, I was promoted up to become global head of new business, at which point I came back to my climate change roots in that I led the business development strategy for the firm's climate risk practice. And so spoke with a lot of insurance companies, reinsurance companies, and other corporates around climate change related liabilities and regulations and how that was informing their net zero strategies. And of course, their interactions with the carbon markets. Yeah. And at some point there, I decided I needed to just spend the rest of my career now focused on climate change because I do think it is that important. And so that is what started the journey to start Kita, which we can come on to.
Look forward to it.
And I'm James. I was a biology and chemistry major, as you say. So I thought I could be a conservational biologist and have a incredible career in that space. But then my parents convinced me to go into the law, which I dutifully did. Spent 4 years in London, actually in-house with Marsh for a secondment. That was my exposure to the dark arts of the insurance broking world, and then into reinsurance litigation. And then I joined the JLT holding company. Spent 7 years with them out in Asia with JLT, and then the last 7 years in the US, but always in kind of market-facing, building strategic projects, placement strategy, that side of thing. But always harboring a secret, conservational grudge that I wanted to get back to. So super keen to get.
Perfect. I think to set sort of the groundwork for sort of the discussion we're going to have is I'd love to kind of get an overview of the carbon markets kind of as a whole, and then we can begin to dive into sort of the insurance element of that, and then just see where the discussion takes us. But do you want to give us sort of a whistle-stop tour of carbon markets and how it works?
Yes.
No pressure.
I will do that. And if you have any questions on it as I go through, just ask them.
Yeah.
I'll ask lots of questions that may seem stupid, but I'm thinking of our listeners.
Exactly.
It's not
we
you. It's
obviously
not you.
know the answers.
It's not how well I'm explaining it, obviously, either. Okay, so at a high level, the carbon markets exist to put money into projects that can either avoid carbon going into the atmosphere or remove carbon that is already in the atmosphere. Mm-hmm. So if I give you an example of avoiding putting more carbon in the atmosphere, it would be do not cut down existing forests. Mm-hmm. Right? Cutting down existing forests releases a lot of carbon into the atmosphere. It's a very bad thing. Mm-hmm. Removing carbon from the atmosphere would be planting new forests, planting new trees that are going to grow up and capture carbon. Right? So at a high level, carbon markets are putting money into projects that either avoid carbon going into the air or remove carbon from the air. Mm-hmm. And obviously to fight climate change, we have too much carbon dioxide in the air, and we are also putting way too much more carbon dioxide in there. So it's a core part of fighting climate change.
Yeah.
And just so that all makes sense at this point. So people are actually looking to do this, but why? I guess because obviously we all want to, but it's not for charity. There's a special reason that firms or people might want to do this. So tell us more.
Yes. So this comes into the two types of carbon markets. So you have two types. One is the compliance market, like the emission trading schemes in Europe, in California, et cetera. Those markets, it's a compliance market. You don't have a choice. You have to do it. If you are a certain type of company and you are in the compliance market in that region, you have to look at purchasing compliance carbon credits. Then you have the other type of carbon market, which is the voluntary market. And this is, broadly speaking, the market that gets most press. The voluntary market is where companies are making a voluntary commitment to be net zero. And that voluntary commitment is becoming less voluntary, but it still is voluntary. You have sort of soft regulations coming up, like Task Force for Climate-Related Financial Disclosures, that are outlining how companies should be reducing their emissions and then looking to purchase carbon credits for each ton of carbon they can't yet reduce from their own operations. But this would be done on the voluntary carbon market. And so the voluntary carbon market, the reason why you would do that is where the argument comes a bit into why would you do that? So companies do it to get ahead of regulations. So thinking actually almost inherently the regulations will tighten up in a lot of jurisdictions around the world, whereas right now it's a nice thing to do, but it will become a thing you have to do. So if you're looking at getting ahead of that, buy carbon credits today. Such as that you can have what they would call a high integrity net zero strategy. You're looking at avoiding all the emissions you can, flying less, reducing, moving to renewable energy, and then purchasing high quality carbon credits for the remaining. Other companies are looking at it as a new financial market. So thinking actually lots of companies around the world will need to buy more carbon credits. Carbon credits come from carbon projects like planting trees, restoring peatland, mangroves, etc. There's a finite supply, and thus the price of this new commodity, this new asset class is going to increase. So you get a lot of asset managers, traders, etc., who are looking at it as a place to get a new return on their investment.
That's fascinating.
Yeah.
Almost in anticipation of a secondary market.
Yes, exactly.
Wow.
Exactly.
Okay.
I can give you a lot more detail on the carbon markets. Those are just two high levels. You have the voluntary market, the compliance market is important. Those are some reasons why people are buying. If of interest, I can give you subtypes of types of carbon credits, what the metrics of quality are. It is high level, easy to understand. You get into a lot of detail.
I mean, the first major takeaway is that clearly the Kita team is very well informed, which is very reassuring. So these are your experts, insurance and reinsurance folks, if you need to get involved in the carbon markets. But also, I think, James, we talked about this briefly on the way into the studio, but really exciting that you're working on a project that is not just, something that's hopefully going to make your company money and money for insurers and reinsurers, but also something that is helping companies to pursue not just compliance, but also voluntary activities. And I know that there's been quite a substantial shift in the narrative generally, even in places like the US, which have been quite hardcore. It's all about making money in business. That shifting in a contemporary sense towards actually there's a social responsibility that comes with being a corporate citizen. You have shareholders, you have a community that you belong to. So I guess this is a part of that as well.
Yeah. I mean, on the investment side, the opportunity is huge. So we didn't kind of pull in some numbers there, but the compliance market was around 800 billion last year. The voluntary market was only 2 billion, but the potential estimates are that it could grow to about 50 billion by the end of 2030, and then 1 trillion by the end of 2050. And that's just a sort of kind of carbon maths that's out there to say by 2050 we need to be removing 10 billion tons of carbon per year. And the estimate is that that's going to cost about $100 per ton. So there's your sort of 1 trillion TAM. So that, wherever your politics may lie, there's a sort of investment play to be had in.
Well, and I think as you pointed out, the compliance market is initially larger, and I think a lot of these efforts start by being led by governments or pushed by governments. But as you have a more sort of conscious consumer base who respect and appreciate brands who are doing more, you're seeing them put their dollars to work in brands that they sort of are inspired by in a lot of ways now. And I think you will see that side of it begin to and continue to grow more and more. So hopefully these solutions like you guys are putting into the market will help encourage companies and make it easier for them to sort of push projects forward and things like that. So I think it's super interesting to see how that market will continue to grow. But it's absolutely, in the next decade or two, you're going to have a huge market growth here.
Yeah, I think 100% it will be a very, very significant market. And I think the other point, there's a few points here to make. In terms of why it's a significant market, because I think on one side you have those numbers James just referenced. So, 1 trillion market by 2050, that's based on the billions of tons of carbon that need to be removed and the potential price for that carbon. You also have the market that is actually investing directly into the infrastructure of the companies that are going to be removing carbon. So you have your nature-based solutions like planting trees, restoring peatlands. You also have your new technologies coming in, like your direct air capture plants, your biochar facilities. I know you might not know what those technologies mean, but they are in essence new technologies that have high infrastructure. And they have their own just direct investment into that infrastructure, which will be its own separate insurance market that has nothing necessarily to do with actually the 1 trillion, which is the carbon credit they end up selling. So we think of it somewhat like a commodities market. Some people talk about it like a bond market, but I think a commodities market is easiest to understand. You have the companies themselves that are going to be capturing carbon, and they have their own investment needs and their own insurance needs. Then you have the companies who'll be buying carbon. And just like in a normal commodities market, some of those purchases are forward purchases, which is where our insurance product today comes in. Because of a lack of supply, you secure your supply early before you've actually received a verified carbon credit. So let's say before the trees have grown. But you have your buyers of carbon who need their own protection. And then you have your financial markets that spring up on top of that are looking at carbon as an asset class, your secondaries markets, et cetera. And that needs its own protections as well. And Kita's focus in this whole space is really around how do we today recognize where we are in the market where you have these projects that need financing. So how do we de-risk the financing so that more money can go to high quality carbon projects so they can scale faster? Because the subtext, again, of all of the numbers are the actual billions of tons of carbon that need to be removed from the atmosphere. And because of the way that carbon dioxide sits in the atmosphere, it stays there for thousands of years. You need to be removing it as quickly as you possibly can. And most of the scientific targets say, really, this decade, the 2020s, is the decade we need to scale these solutions, and we're running out of time to do it.
So is that the primary challenge that you're seeing in the market, is the ambition to kick these projects off, but the sort of constraints around the ability to do so or the risks associated with it, and that's kind of the primary challenge that you guys are sort of set out to tackle? Or are there other challenges that sit around that as well that are sort of grouped into the broader solution?
There's a lot of challenges. I can take the first bit of that and then let James come in, who's come in now from the insurance perspective, speak with a lot of the insurance market and reinsurance market and get your perspectives on it. I think at a high level, you have the challenge of what we as a society need to do, and then you have the challenge of implementing it, which is the core challenge. I think for companies who are looking at buying carbon credits, whether for net zero strategies or as an investment portfolio, probably the key challenge they have is that it's actually a very hard thing to buy. There's a lot of choice. So you could have afforestation, you could have avoided deforestation, you could have mangroves, you could have grasslands, you could have biochar, you could have DAC, you could have renewable energy credits. There's not much consistency really in what a high quality credit is. So if I can buy one credit for £3 per ton and another one for £800 per ton, why do I do one versus the other? And then you have a lot of the reputational risks around, actually, now I've bought carbon credits, and next step is I'm going to get splashed on the front page of the Financial Times because it turns out that this project that was very hard for me to do due diligence on in the first place turned out to be not that great. And everyone's saying it's my fault. And so I think one key challenge is that it's just a scary thing to buy. And you're sort of between this rock and a hard place. You have to buy it. Because if you don't buy it, you're not going to meet your net zero strategy. But it's a hard thing to buy. And if you buy it, you might be put on the front page of some newspaper for greenwashing. And so I think one core solution that we, or insurance more broadly, is providing is actually a kind of stamp of confidence that provides an additional level of due diligence and quality assessment for people who are looking at how do I engage in this market. So that is one core challenge that I think we fix. But
I agree. No, I was going to say it's a supply issue and a trust issue. I think insurance can help on the trust side by giving that stamp of approval. The supply is tough. There's not just sort of one giant forest that we can plant that will fix the problem, or one technology that's gonna save the day. It's going to be a broad portfolio of things. And as I was learning about the space, I was trying to get my head around some of the stats. So that 10 billion tons that we need to remove by 2050, to get to 1 billion tons, you'd have to plant a forest the size of Texas, and there's just not that many, or the size of France. There's just not that many, available space left. And as the population grows, we're going to need more and more of that space for arable land. So you're going to need a very diversified kind of technology solution to get through.
Yeah.
And then, interesting, you're talking about sort of how it's viewed as a commodity. I think for the financial markets want to see it as a commodity. From the insurance perspective, I definitely see it more, a sort of risk perspective, more as a sort of municipal bond. It's location specific, it's developer specific, technology specific. Different rules and regulations in every country, geography there is worldwide. So it's a beautiful product in that sense to be an underwriter for, because it's going to need bespoke underwriting, account by account. It's not something you can bundle up.
That makes sense. And I guess everything you said, very clear in terms of why you'd want it as a buyer. Mm-hmm. Could you just add some color in terms of what sort of risks, I guess, putting it in our insurance language, if you've invested in a project, is it the trees didn't grow or they burned down, or what type of things are the main hazards that we'd be watching out for?
Yeah, of course. And let's split it slightly between the categories of carbon. So you have nature-based solutions, which are quite inherently carbon that is stored in nature and natural processes. And then you have your technological solutions. They have different risk categories. So we stick with nature first. So the key risk that we cover right now plays a bit into how the carbon markets work. At a high level, a carbon project, when it starts, goes through something called validation, which is based on its plan. It goes to something called a carbon standard, which is sort of one of the kind of quasi-regulators within the market. They give the carbon standard their plan for how they're going to plant these trees, and that gets validated, saying, based on your plan, we think you will have X tons of carbon over the next 30 years. Mm-hmm. Then they start running their project. At some point, they'll get verified. And that's when someone will come around, measure their trees, and say, yes, the amount of carbon we thought you had, you do have. Mm. And then onwards from there, every year it gets verified. So right now, the key risk that we cover is, given the lack of supply in the market, people will invest in a project at that validation stage before, I'm going to stick with trees because it's simple, before the trees have actually grown up, before they have a verified carbon credit. So thus, I have given you money today, and I'm going to get a verified carbon credit in 5 years' time. And we're talking about trees. Mm-hmm. So the risks are, one category, your unavoidable loss, right? Your natural catastrophe, like your climate change itself, right? The fires, the storms, etc. That is quite an obvious risk that the reinsurance market understands, the insurance market understands. You then have the second risk, which we would term avoidable risks. So this is now the actual project developer who is planting and maintaining these trees. They might be fraudulent, they might be negligent, they might go insolvent, or they might just change their mind and abandon the project. Right? You can very much see the price of timber might spike up and the price of carbon might go down, and they think, I'm going to cut these trees down, I'll make a lot more money. So you have those kinds of avoidable losses. And then you have your carbon risks. And this is very specific to how the carbon markets work. So the methodology via how you quantify the carbon in the first place, that could change. Some new science could come to light that changes how much carbon I have or I expect. Or the carbon standard, that's actually the one assessing your credits, that could go insolvent, and thus you have nothing. So you have these kinds of three buckets of risk: your unavoidable, your avoidable, and your carbon risks. Plus, we were talking a bit about this amorphous Article 6 risk before the podcast started. You also have your political and regulatory risks, which again go into the global rules as to how carbon should be accounted for between countries and sellers and buyers. There's quite a lot of risks. That's before you've even received a verified carbon credit. That's what we would term delivery risk. Once you now have a verified carbon credit, I own this credit, I'm going to retire it against my net zero strategy. You still have fraud and negligence risk. What if it's invalidated? And you also have another key risk would be called your reversal risk. So the whole purpose of my investment is that carbon is permanently stored away underground. However, there's quite an obvious risk that a fire might come and burn up those trees, and my carbon goes poof back out into the air. And what does that mean for me as a buyer?
Yeah.
Quite a few different risk categories here.
Yeah, and it makes complete sense, and that you're highlighting the complexity of this. But before the show started, you were talking about sort of some of the sort of interesting sort of challenges clients are coming to you with. Because again, I think it's one thing for companies like ours to sort of build something and hope people want it, but it's something fundamentally of higher value when you're sort of building a strategy somewhere, and then people are coming to you saying, we are wrestling with this problem. Can you help us there? What are some of the ones that are most intriguing as you build sort of insurance products that sit here, the challenges that clients are coming to you to help them solve?
You want to take that on?
Yeah, sure. So I mean, the existing product we have covering those three buckets, I think that's shown a lot of interest. Reversal risk is one we'll be looking at, and I think that's going to be key as things scale up. And then the other one would be the
Article 6.
Article 6, yeah, political risk. So, I think that's where there's the highest demand right now, but the legislation and the regulation is moving around too quickly for us to kind of really get comfortable with the risk. But we're trying to analyze it and say, big picture, it's quite a scary area, but can we fine tune it and get comfortable with particular risks with a particular wording and policy form? So that's something we're very keen to work for.
Exciting.
One of the challenges with this market, and this is probably inherent to most new markets where there hasn't been insurance penetration before, but this market is very quickly changing. Just as a market, as climate change changes, as regulations and expectations on companies and individuals in terms of climate change adapt around the world, I'd say you have to balance, when you're looking at insurance for this market, the real risks and the perceived risks, because sometimes the perceived risk will shoot up. So right now there's been a lot of reports of fraud and negligence in the market. So everyone is really worried about fraud and negligence. As soon as we hit the summer months, there's going to be some fires. Everyone's going to be very worried about natural catastrophes. Right? Article 6 is something that's very much in flux right now, so it's a huge risk. In a couple of years, it'll be a very manageable risk, I would expect. And so I think the challenge for us was always trying to engage with the clients to figure out what their concerns were, and then figure out which of those were going to be somewhat sort of seasonal concerns, and then which of those were core concerns, and which of those core concerns are insurable or not. But that is still very much an education process, I'd say, realistically, in this market, and it will be for the next few years.
I'd love to hear a bit more about how you think about the underwriting process here as well, right? So you've got a few different categories. Some, and I'm guessing at this, so please correct me when I get this completely wrong, but you've mentioned planting trees in an area where they potentially might burn down or be exposed to natural catastrophes. Presumably you often know where those trees are going to be ahead of time, so you're effectively doing a sort of natural property damage in the future type scenario, or NatCat in the future for a particular location. Then it gets a bit more complicated towards sort of some of these fraudulent risks and some credity things. Then Article 6, which, just because I want to show off what I know this is, I think it's Article 6 of the Paris Climate Agreement,
Yes,
2015.
it is. Well done.
Only finally brought to life at COP26 in Glasgow, possibly.
27.
27.
Came
So
out.
close. I tried hard to sound informed. But yes, that then you're looking potentially at political risk and, governments expropriating bits of land or similar and saying, oh, actually that's we're counting that towards our thing, not yours, or they sell off their bits that they're supposed to be counting, which is a completely different underwriting skill, the way that our market traditionally would box up things, right? So it feels like this is something that needs quite a range of expertise to tackle in its entirety. How do you see the underwriting effort coming together to tackle this new risk and opportunity?
Well, I could talk through the high level of how we came to where we are, and then maybe let James talk through some of the insurance sub-aspects of that. But I suppose when we first started investigating, and I say we, it's myself and my two co-founders, when we were first thinking which product, of all these truly many product options, which one should we bring to market? We were speaking to buyers and asking them, what are you most worried about as to why you might not receive your carbon credits? Is it fire? Is it wind? Is it pest? Is it negligence? And it was very obvious that no one really cared why, and then also that no one could come to agreement on like the specific sub-risk. They just cared that they didn't receive their carbon credits.
Yeah.
And so we quite quickly started thinking, okay, instead of like a fire policy where carbon is the sum insured, how do we look at more all risks type policies? So warranties, credit, surety, parametric type policies. That would enable us to cover a wide range of sub-risks, but still with a reasonable protection that isn't exposing us to like a gazillion different things. And so our existing policy looks most like a credit policy. So it's an under-delivery or non-delivery of carbon that can't be made good via the terms of the carbon contract. And thus, we look a lot at the contract to see how strong that contract is and how likely a default is. The key thing we actually exclude right now from that cover is that political risk, that Article 6 risk, because it's so rapidly changing. We didn't think that we could price it. I think we're getting to the point that we could price it, but we certainly weren't there yet. But we looked at it from that perspective, the kind of what all risks type policies. And then we also looked at it from the perspective of what other insurance policies exist in similar markets that we could copy, because we're not trying to reinvent insurance. We're just trying to take insurance into a market that needs insurance. So that was our original thinking.
Yeah, and I think that one of the things that really excited me about Kita was that sort of technological horsepower they've got and the sort of agility. So the underwriting model that they've built, I think there's 54 sub-factors in there. The co-founder, CTO, was ex-quant hedge fund. So he sort of took that approach and then insurance-ized it. But so 54 factors, but then you group those into sort of 7 key factors, and credit is a key one. There's a little bit of nat cat, but it comes down to sort of these 7 key buckets and a weighting for each, and which one we think has the most impact on a risk-by-risk basis, and then kind of loading that for particular risk profiles as they come in, and then adding in a conservative factor because it's a new risk, taking proxies of data that we can build and carbonize from now and over time, and then underwriting, kind of virtual underwriting what has been out there and how our model would perform against that now, and kind of tracking the losses, potential losses as they come. So we're kind of building up a virtual underwriting pool, as well as writing live risks and getting kind of quite close feedback as we go.
Yeah, is the current approach, or I'll take a step back. How do you think about distribution of this product and the sort of future products you'll have, sort of now and then in future? It feels akin to kind of how the cyber market began to evolve, where here's a net new product, and then over time it began to be embedded a bit more. Are you seeing something similar maybe evolving in where you guys are playing?
Yes, definitely. And as an ex-broker, I think one of the things that was frustrating with working with MGAs was that, feeling that you're trying to be disintermediated. So definitely want to embrace that. I think in the mid to long term, it will definitely be a brokered model. It's going to be a complex risk transfer product. You want to go to your insurance broker for advice as how to structure and place that. In the short term, there are kind of opportunities to go direct, but we'd like to really build a market, build the trust, and work very closely. So I've been in London pounding the streets of Fenchurch Street this month, just doing that, kind of going out to see as many brokers as we can. Yeah. And it's great feedback because we've built an insurance product. We think we think it's what the client needs, and we've had direct client feedback on it, and they like it. But it's another thing from having real insurance broker experts who are used to selling a risk as well, and they'll say, well, actually, we like this coverage, but can you change X, Y, and Z? And there's some things that we maybe hadn't thought about, but very good feedback and tailoring to what the client needs from an insurance perspective. Yeah. Particularly when it comes to claims.
Yeah, because it feels like when you look at the broker's role in both insurance and reinsurance, it's this deeply advisory sort of capacity role that they hold, and this being, if it's on the radars of these executives of these companies, especially those who are choosing to opt in to being climate or having a net neutral position, this feels like it should be something that's brought up in those discussions as they look across their portfolio of risk that their business has. This being something that the brokers can bring up in that discussion and help them navigate. And if there's products in the market that help them do that, everybody wins in that case.
I think that's exactly our perspective as well. And so I think the challenge right now is just that it is such a new market and it's quite complicated. And so it's us trying to partner with the brokers to make sure they actually understand it. And then we think there really is huge potential for them to bring something both innovative, but also really essential to their clients. One of the challenges is just that education, because right now the client is going to go to their broker, right? So I'm financial lines, I go to my financial lines, energy to energy, marine to marine, et cetera, et cetera. Because there's no like central, I'm going to go to the carbon team.
Yeah.
And so it's trying to build up that breadth of knowledge across the market so that no matter where that specific client decides to go, ideally they have some knowledge of carbon and can direct them to the best carbon insurance product out there. And I do think there will be more and more carbon insurance products, which again, like James said, will back up the fact that it will become a broker market because clients want that choice.
That makes
Right
sense.
now, though, it's very patchy.
Yeah.
And that's the client side, I guess. So how do you go about attracting the capacity on the other side? I mean, you mentioned virtual underwriting. That sounds really exciting as a way of getting, evidence together about why this is something that's worth putting capacity behind. How's that been, the journey to convince some paper to follow your underwriting talent?
I think we got really lucky on this. I mean, we met at Lloyd's Lab because we are both Lloyd's Lab alumni, but we got into Lloyd's Lab when we were 4 months old. And we truly went in thinking we want capacity. That is what we wanted. And so we got really amazing opportunity to work with Chaucer and Munich Re. And I think we immediately saw that they understood the opportunity here, that this is a brand new market, really without much insurance in it at all, and it has potential to become huge. And I think they saw that Kita could bring the skills and knowledge of that market to access it. And so we had the opportunity for them to be our mentors and help direct us in terms of what they would back and what they would not back, which was very useful. And we've really been working with them since last April. And so Chaucer, Munich Re Innovation Syndicate, and Renaissance Re then ended up giving us our capacity. But it truly came out of Lloyd's Lab, and it never would have happened as quickly if we hadn't had that kind of mentor relationship. If we'd just gone to them with, like, here's a product, I think we would have had that classic struggle of, well, it doesn't really fit. It doesn't fit. It's not, it's not credit. It's not political risk. It's not energy. Like, it doesn't fit. And we avoided that it doesn't fit conversation because they helped us to shape it from the outside.
Yeah, and it's a very we've talked about the value in the product that Lloyd's has as a brand, but this very much fits that profile.
Yeah.
Like, here's a risk that doesn't exist in the market yet, that needs to exist and needs to be priced and needs to think through that, the complexity around that. And Lloyd's is perfectly suited to be those people who can sit down, understand it, think through it, and work with you alongside that. So that's a super exciting development there.
I think they just need to have the interest in figuring it out and then pitching it internally. And I think they all did. And that was almost half the battle, I suppose, is getting someone bought into the idea and then agreeing that you'll figure out the details.
Yeah.
Yeah, absolutely. And it does feel like one of those problems that in a older imagination of our insurance market could have sat around going through committee after committee and not getting anywhere. But I think everybody around the lab and in our community has been super impressed by how quickly Kita's got going. You've managed to storm in and be like, we found a thing that needs fixing, who's with us? And as you said, it's come together really rapidly. So hats off to you guys for, tackling this market by storm.
Thank you.
Yeah. I think we're at time. Is there anything else you'd like to share with the whole world of reinsurance listeners out there?
Well, just a couple of concepts that we're kind of brooding over at the moment. So we underwrite projects that remove carbon. One of our sort of metrics is obviously premium written, but we like to think in terms of carbon written as well. So gross written carbon will be a sort of metric that we're closely following. We think it's something new that the whole insurance market would love to embrace. And then also thinking in terms of underwriting, there's a net zero investment strategy, but there's also a net zero or net negative underwriting strategy. So we love to sort of partner with with the market and with brokers that want to embrace that kind of thinking. So it's not just on the balance sheet side, but as a sort of underwriting opportunity as well.
Absolutely, yeah. There's certainly been a lot of lost insurers and reinsurers out there trying to figure out how to transition away from fossil fuels and how to do something meaningful with their power. Maybe this is it. Get behind initiatives like Kita and you'll be well away.
Yeah, and it's powerful for their brands as well. The logos you talked about from the capital side, these are the brands who want to sort of make that positive impact on the planet. So those approaches, I think, is the right way to enter this space.
Yeah, I think with carbon, if you do it well, like we do, but I think like any insurance or reinsurance company would do, with a lot of due diligence into what you're backing, I think the profit plus purpose is completely intertwined.
Yeah.
Because we are quite literally insuring tons of carbon going into the ground, and we protect against the risks that carbon comes back out. And so if we are successful and we underwrite good projects, the profit and the purpose go completely hand in hand. And so hopefully that will be an exciting opportunity for the insurance and reinsurance industry going forward.
Definitely.
No, super exciting. Thank you both for joining us.
Yeah, thank you.
Thank you.